Now, you might notice that I'm not wearing a tie today, which is pretty unusual for me. Well, I'm cutting back a little bit on my already low tie budget, as nearly 10% of my life savings have been wiped out this week alone. In moments of economic stress, global markets don't wait for a policy consensus, they react in real time. And when two of the largest economies in the world clash over trade policy, the shockwaves spread fast and tend to be pretty far reaching. The current tariff escalation between the US and China is triggering one of the sharpest market corrections in recent years, but this goes a lot deeper than just the stock market. What we're seeing here is a clear example of how uncertainty in trade policy unsettles the entire financial system, puts pressure on global banks, and forces central banks to respond quickly. But before we get into it, if you find any of this helpful or insightful, hit that like button and subscribe below. It really helps out the channel. For some context to everything that you're seeing in the news, this isn't the first time that back and forth tariffs have shaken global markets. Trade tensions have long been used as a political tool, from the Smoot-Hawley Tariff Act in the 1930s to more recent trade battles in the 2010s. But what makes this moment stand out a little bit more is the scale, timing, and the broader economic environment we're living in. We're entering this period of uncertainty not with a strong, united global community, but during a time of high interest rates, international conflict, and fragile supply chains that are still healing from the pandemic. Right now, the US is putting tariffs on a range of essential goods from semiconductors to pharmaceuticals, while China is hitting back with a 34% tariff on all US imports. And the move is surprising markets, not just because of how broad it is, but because of its timing. It lands right in the middle of growing recession worries in an already shaky market. If you've watched our previous video on how tariffs work, you'll remember that they're basically just an added tax that raises the cost of imported goods, which reduces trade flows and creates deadweight loss. That means businesses and consumers will both feel the impact. Companies have to either absorb the higher costs or pass them on to the consumer in the form of higher prices. And for consumers already feeling the effects of inflation, even a small price bump can significantly change their spending habits. But beyond the basic economics, tariffs send a more broad economic signal. They tell the world that trade policy is turning more inward, that supply chains are likely to get more expensive, and that companies may need to cut their profit expectations over the next few years. Now, this dynamic is playing out immediately in the capital markets. Major US indexes are dropping fast. The Dow's down nearly 1,700 points at the time of recording this. The NASDAQ, loaded with global tech firms, is off more than 4.5% just today, and it's rapidly approaching bear market conditions. These aren't just symbolic thresholds, they reflect a serious shift in investor sentiment. And when tech stocks lead the way down, it often signals broader concerns about growth, innovation, and international exposure. But as I've already said, this isn't just about stocks. The bond markets are reacting just as strongly. Investors are pouring their money into US government bonds, which pushes the price up and yields down, with the 10-year yield now well below 4%. Lower yields are a classic sign that investors are looking for safety. It's what people do when they're uncertain. When long-term bond yields fall, it also signals that investors are worried about future growth. That's why bets on rate cuts are rising quickly. Markets are now expecting the Federal Reserve to lower interest rates, maybe even more than once before the year ends. That's a big turnaround, especially considering the Fed had just been focusing on keeping rates high to fight inflation. Just last week they decided to hold rates steady and showed little desire in lowering them anytime soon. But that might have to change now. At the same time, the banking sector is under pressure. Banks with large global operations are facing a pretty tough mix of problems. First, falling bond yields hurt their core business because banks make their money by lending at higher rates than they pay on deposits. So when the yields drop, their profit margins shrink. And for institutions already facing tighter regulations and higher capital requirements, any hit to profitability puts pressure on their ability to lend. This can compound the slowdown, especially for businesses relying on access to credit. Beyond that, when trade slows down, businesses borrow less. That means fewer loans, fewer international payments, and less money made from helping companies make deals. Lastly, there's growing credit risk. If the global economy slows too much, more businesses might default on their loans, especially those already carrying a lot of debt. Even large, well-established banks are seeing their stock prices fall fast. And it's not just here in the US. Banks in Europe and Asia are being hit too. Now, all of this would be worrying on its own, but right now we're seeing investor sentiment get significantly worse. A recent survey shows that more than 60% of individual investors think the market is going to keep falling. That's the most negative reading since the 2008 financial crisis. When people expect the worst, they often act on it. They cut spending, delay investments, and move their money into cash or bonds. That kind of reaction is logical, especially when the environment feels unpredictable. But when millions of people make the same cautious choices at once, the collective effect can drag the economy down even faster. And that kind of behavior, just worry feeding more worry, it can make things a lot worse. So where do we go from here? Well, when things get shaky, eyes often turn to the Federal Reserve. Fed Chair Jerome Powell is set to speak soon, and markets are watching closely for any signal in a shift in policy. The Fed is trying to balance two tough jobs, keeping inflation under control and making sure the economy keeps growing. That's pretty hard to do when trade policy is just adding more uncertainty. It doesn't matter what political camp you fall into. As I've said before, this is not a political channel. Tariffs, by their nature, push prices up and slow down spending. If the Fed doesn't respond carefully, this added pressure could lead the US into an economic slowdown. So one option the Fed has is to cut interest rates sooner to soften the blow. But cutting rates too early while inflation is still high, well, that just risks making inflation worse. So this is a really tricky balancing act. I have an insane amount of respect for Jerome Powell or anyone who has had to keep this ship sailing over the past 2 decades, and I can confidently say I don't envy his position right now. And I wouldn't expect much help from Congress on all of this. There's little sign of a major fiscal response coming, so most of the burden is going to fall back on the Fed. Well, we've spent a lot of time talking about the immediate impact, but there's actually a bigger picture worth thinking about too. The way countries trade with each other is changing. We're seeing more governments rethink how much they rely on other countries like the US for key goods. Some economists call this economic separation, where countries prioritize control and resilience over low costs and efficiency. And this isn't just a US-China issue. Governments across Europe, Asia, and the developing world are all asking similar questions. They're trying to diversify supply chains, bring manufacturing closer to home, and stockpile critical materials. But making those changes isn't cheap. It takes a lot of investment, reworking of logistics, and usually leads to higher prices, at least in the short term. For companies, this means weighing the cost of resilience against the risk of future disruption. And for consumers, it means adjusting to a world where low prices aren't always guaranteed. Guys, don't be influenced by other things you might be reading or watching. In the long run, all of this could absolutely make economies more stable. But in the short run, it adds a lot of turbulence and could have some pretty devastating repercussions. As always, we need to assess the opportunity cost here. Is the potential of long-term strength worth the high likelihood of short-term pain? That's the question few people are asking, but I think it's the most important question on the table. If you enjoyed the video, please like and subscribe. It means the world to me, and until next time, have a good one.